Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Between end July and end October, global equity benchmarks fell circa 11% and experienced a correction. However, in the week ended November 3rd, the same indices rose more than 5%, marking the best week for the asset class in almost a year. A week like last one should remind long-term equity investors of the importance of staying invested. Looking ahead, going into the year end, we would remain overweight equities in our tactical asset allocation framework for 4.5 reasons. Yes, precisely for 4.5 reasons. Reason number one, a peak in 10-year US Treasury yields. Equity markets are likely to benefit from the 10-year US Treasury yields peaking. Positive correlation of equities to US Treasury bonds means directionally equities can deliver gains. Equities are also a high beta play, making them outperform 10-year US Treasury bonds in case US Treasury yields indeed fall. However, bond yields falling due to a recession are not supportive for equity risk. But our base case does not assume a US near-term recession anyway. Reason number two, seasonality support. Based on the data over the last 35 years, global equities as measured by MSCI All Country World Index delivered an average return of 4.4% between the months of October and December. Reason number three, technical revival. After the most recent move lower in global equities, which saw most major indices below their 200-day moving average, equity markets are likely to experience a bounce that could last several weeks. Also, the National Association of Active Investment Managers Index recently registered its biggest weekly drop since 2008 and is now 2.5 standard deviations below the 10-year mean. This provides a strong contrarian buy signal for equities as an asset class. Reason number four, supportive earnings trends. Earnings improvement continued over the last couple of months. Profit margin expectations continue to improve. Earnings growth expectations continue to rise, and earnings revision momentum has turned positive for the first time in almost a year in early October. Q3 earnings season has been strong too. According to the data from Refinitiv, of the 376 companies in the S&P 500 index that have reported earnings to date, 81% reported above analyst expectations, and this compares positively with a long-term average of just 66%. And now the half reason, relative attraction of equities to bonds. To be overweight equities, our tactical asset allocation framework forces us to be underweight fixed income. In that context, over the medium to long term, there are reasonable alternatives to equities within the bond space. Yet, over the near term, we think bonds are likely to face elevated realized volatility, making them less appealing compared to equities on a risk-adjusted return basis. Taking all these together, we remain overweight equities into the year end. Within equities by region, we favor US and Asia, and by sector, we prefer technology, healthcare, and industrials. Our constructive view faces risk from politics, geopolitics, monetary policy, and growth shocks. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. This is Kishore Muktinutalapati signing off.